Well, it's changed massively over the 30 years I've been in it, right? It used to be boring. You went to a commercial bank, you made a loan, you held it, that was it. Then in the 1990s, loans started to trade. So banks, investment banks could arrange it, sell it off to non-banks, it traded. Then 2008, you got huge amount of influx of capital doing private credit, saying, hey, you could come directly to us, a fund, we'll lend you the money, you don't need a bank. And then you had in 2015 liability management, or what the press loves, creditor on creditor violence, that changed the whole dynamic of lending senior secured. It used to be, we're the three musketeers. If Tom owns a debt, you own it, I own it, same debt, same company, we're all for one, one for all, we're the same. All of a sudden, it changed, and certain investors in the same exact debt instrument end up doing better than other debt instruments. So what I would say is, when I started in the business, senior secured lending was boring. I was boring. It was a perfect fit.
Right.
And over time, it became interesting and exciting.
Okay, Michael, folks, I got to cut to the chase here. I mean, Margin Call with Jeremy Irons sitting at the end of the table. Peter Sullivan was the character, Zach Quinto doing it, the junior risk analysis and Margin Call from years ago. Mm-hmm. How many people in your racket really aren't all that smart? Because your book is a tough read, and it makes them smarter. There's a lot of pretenders in credit, aren't there?
No, one, I get myself in trouble if I said there's a lot of pretenders in credit. No, I think people evolved. I think historically, being in credit, you were a second-class citizen because it wasn't as sexy. And it was like, hey, all you have to do is, can I get paid back, yes or no? And it was viewed as a lesser business than, let's say, equity. As equities got more and more efficient, as debt started to trade, as distressed debt buying someone else's problem at significantly below par, where you could have downside protection, but or the upside of converting some of that debt potentially into equity, all of a sudden people got a lot more sophisticated. And the reason I wrote the book is for the younger professionals, there was no book. You could go on Amazon, type, how do I invest in equities? Thousands of books. How do I invest in senior secured, non-investment grade, distressed debt? 0 books. So I wrote it. I got a monopoly. I want to monetize that monopoly while it's still there. And I take a little offense, Tom, and I love you. It's an easy read. I wrote this book so my goal was you read it and say, holy crap, I learned a lot, but that wasn't painful. So every technical concept, like a fraudulent conveyance, right. I ended with an interesting story, like Caesars. Mm-hmm. Big fight over moving assets, accusations of a fraudulent conveyance. So I try to teach all of the technicals that you need to be a credit investor, whether it's performing or distressed, but then use real companies to illustrate it and then tell a war story. So you say, holy cow, that wasn't that painful.
What's your view on private credit? If it weren't for the war in Iran, I think this market would be talking about private credit a lot more. How do you view it?
Yeah, look, private credit historically has been a phenomenal asset class. You're lending senior secured, you put a 1-to-1 debt to equity ratio, and you're getting double-digit yields with downside protection. So it's a phenomenal asset class. Now, basic economics tell you, if you're earning excess returns to the perceived risk, a lot of capital flows in, and that's what happened. A ton of capital flowed in. I just wrote an article on how do you analyze it, because what's going to happen is there's just going to be a dispersion of returns. The players that have been in it, lived through cycles, got punched in the face in 2008, learned from it, are going to stay disciplined. They're not going to get involved in race to the bottom deals. But I think the asset class is great if done
Right.
well. I think some deals that got done were bad deals, and if you did too many of them, you're going to have a problem. But I love the asset
For
class.
Global Wall Street Worldwide, the Credit Investor's Handbook, Michael Gatto with us. We're going to continue with the professor's definitive here with a guy named Solomon of Goldman Sachs writing a forward as well. I want you to talk about the gajillion. We saw the equity deal yesterday from Google, original, large in that. But talk about the demand for the hyperscaler bond offerings. What does it signal to you?
Well, look, a ton of capital is getting raised for data centers. There's going to be equity and debt. As in every fundraising, it's an interesting debt play. The goal of a debt investor is to get equity-like returns with debt-like a downside. Now, there's a question whether some of these debt deals, you're getting debt returns with equity downside, which is the polar opposite of what you want. But I break these into three types. There's the data centers with a long-term investment grade lease, lowest risk, but you got to do your work. One, are there cancellation clauses in those leases? Because you might think, oh, I'm taking meta risk, and then all of a sudden you find out the contract could get canceled after 2 years if certain events happen. So you got to go in. You got to make sure you have the right legal entity. Big companies have massive legal entities. You might have a name that's guarantee your loan that doesn't have the corporate guarantee. So you got to do a lot of work, and that's one end of the spectrum, lower risk. It's got a contract, and then there's the ones that you're building and they would come, and that's a higher risk. But everything is going to get financed with debt and equity.
First Brands. Tell us about First Brands and how that might have been a teaching tool for credit investors.
Look, I'm a professor, as you said. I teach at Columbia Business School, the MBAs, and then Fordham, the undergrads. And I tell every student, learn from mistakes. That's how you learn. Best way, learn from someone else's mistakes. First Brands had 5, and I wrote an article on this. It had 5 red flags. Now, a red flag doesn't mean I'm not going to do the deal. A red flag means I got to dig deeper. And when you went into the first broadly syndicated loan, you couldn't dig deeper, and you had to make a decision. Just because everyone else is doing it, should I? I write about that.
Michael, I got to get this in. I just think it's too important. There's always leverage within the system. Where's the leverage now, or the implied leverage?
Well, I think, and I've heard this, and people have said, is private credit going to be the next catalyst for a downturn? I think it's very misunderstood. When you look at it, is a private equity, let's use a private equity as an example. They're going to buy a company. The private credit investors are usually lending about 50% loan to value. Then they go to the banks. The banks lend them 50% loan to value on what their debt was. So you got a ton of cushion. The company's got to decrease in value by half. Private equity loses money. The debt holder doesn't. Then it's got to reduce by another half for the banks, and the banks are cross-collateralized. So I look at it and say, look, from the stability of the financial markets, this is very low risk for banks that are funding.